Hi, welcome back to another one of our basic accounting segments. In this segment, I'm going to be talking to you about capital stock. We're going to go over a few basic journal entries dealing with stock, and we're going to prepare the stockholders equity section of the balance sheet that's dealing with stock. We're going to do that. We're going to go over an example. Before we do the example problem, I'm going to take you through some definitions of some of the basic definitions you need to know about stock. And we'll start out with here. I kind of wrote this down for you. Authorized shares. Authorized shares is the maximum number of shares of capital stock that can be sold to the public. That's authorized shares. Back to authorized shares again. Authorized shares is the total number of shares that can be sold. Now, once you sell the shares, they become issued. So issued shares are authorized shares of stock that have been sold. Unissued shares are authorized shares of stock that have never been sold. Usually shares are sold through an underwriter. Now, let's come back to this again. Let me show you something here. Once again, we're talking about the total authorized shares. Now, you can also have what they call outstanding shares. Outstanding shares are issued shares that are owned by stockholders. Then you have what they call treasury shares. Treasury shares are issued shares that have been reacquired by the corporation. Of course, we already talked about the unissued shares. That is, once you issue shares, they become outstanding. When the company decides to buy them back, because the company can repurchase the shares, they become what they call treasury shares. They're no longer outstanding, but they're issued, but they call treasury shares. Let's look at common stock. It's going to be a form of stock that we're gonna go through. It says common stock can be issued in three forms. It can be par value common stock, and that's the stock that we're going to focus on in our example. No par common stock, which in that case all proceeds are then credited to common stock when it's a no par common stock. And then you have what they call a stated value common stock, and it's treated just like common stock. Let's look at common stock and some of the characteristics. Of course, as a common stock holder, you have the right to vote. Of course, you receive dividends. You're also given a stock certificate. I kind of drew one out here the best I could there. Par value in that stock is an arbitrary amount assigned to each share of stock when it's authorized. So it's identified. The value of the stock is identified. When it's authorized, it becomes the par value. Of course, you always have what they call market price, which is different from the par value. And the market price is the amount that each share of stock will sell for in the market. Of course, that's going to vary depending on how the market is trading on that particular stock. That's common stock. We also have another stock that we deal with called preferred. Preferred stock is a separate class of stock, typically having priority over common shares. That is, if dividends are given out, they're particularly going to get their dividends before common gets their dividends. Also, preferred stock can be accumulative and non-accumulative, and we'll talk about that later. And of course, normally has no voting rights. And let's look at what we're talking about, accumulative and non-accumulative, when we're looking at preferred stock. Here, accumulative preferred stock means that dividends in arrears must be paid before dividends can be paid on common stock. Non-accumulative says undeclared dividends from current and prior years do not have to be paid in future years. What does that mean? That means that if it's accumulative, if we declared dividends, the company declared dividends in the prior year and did not pay preferred, they must pay the back dividends and also the current dividends of that year before dividends are given to common stock. That's the difference between accumulative and non-accumulative. If it's non-accumulative, you're only concerned with the current year and you're not concerned with the prior year of the dividends. We talked a little bit about treasury stock and treasury shares, and I mentioned it earlier. Treasury shares are issued shares that have been reacquired by the corporation. Of course, these shares, there's no voting or dividend right, so you don't receive dividends. The company doesn't receive dividends on that stock. It's also a contra equity account. Also, when stock is reacquired, the corporation records the treasury stock at cost. And we'll see that in the example that I have for you in this segment. So now that we've done that, let's look at the example problem. And now this example problem is comprehensive, so I'm going to read it down a little bit, and of course you can follow along because you'll be able to download this example. It says here, Stephen Williams and several friends organized a corporation called Williams Holding Inc. The corporation was authorized to issue 50,000 shares of $100 par value, 10% accumulative preferred stock, and I'll go into detail what all that means. That comes to play when you talk about dividends, and 400,000 shares of $2 par value common stock. And it says here, the following transaction, among others, occurred during the year. And I'm going to read these first, and then we're going to go back and record these transactions in the journal. On January 6th, they issued for cash 200,000 shares of common stock at $14 per share, which that $14 per share, that's your market price. That shows what these shares was issued. Got an error here, but these should be shares. Shares were issued to William and 10 other investors, which means that they decided to give William some shares and other investors also. On January the 7th, issued an additional 500 shares of common stock to William in exchange for his service in organizing the corporation. The stockholders agreed that these services were worth $7,000. So in exchange of William's service, the company is going to issue him 500 shares of common stock that they think are worth in the market $7,000. On January 12th, they then issued 2,500 shares of preferred stock at a market price of $120 per share. On January 14th, they acquired some land as a building site in exchange for $15,000 shares of common stock. And what happened in this transaction, the company saw a building and decided, we want the building, so who's selling the building, we'll give them 15,000 shares of common stock in exchange for that site. In that particular transaction, we feel that the stock is worth $15 per share. That's considered a market price at that point. Then on November 15th, the first annual dividend of 50 cents per share was declared on common, and preferred stock will receive the normal, change the page here, will receive the normal dividend payout with no dividends in arrears. So there's no dividends in arrears on that, to be paid on December the 20th. Then December the 20th, of course, we're going to pay out the cash dividends that was declared on November 15th. And then December 21st, the corporation decided to repurchase 100 shares at $17 per share, which means this is going to end up being treasury stock, and I'll show you that in the journal entry, because they're going to repurchase what they issued originally of common stock. On the 29th, the corporation then sold 50 shares of the 100 shares repurchased on December 21st for $20. So they repurchased them at 17 and then turned around and sold the treasury shares for $20 per share. And I'll show you how that transaction works too. And of course, this last transaction says after the revenue and expenses were closed into the income summary, which I told you how to close out revenue and expense accounts early on in the segment. We're going to go through that. And they said the net income for that period was $147,200. Now we're going to go ahead and record these transactions, in which I've done that, and I'm going to show you what it looks like. The first one, remember, here we issued 20,000 shares of common stock at $14. In this case, we record the cash here of $280,000, which is $14 times the 20,000 shares of common. That's all the money you got. But however, we record the common stock at par, which is the 20,000 times the $2 per value of common stock to give you the 40,000. The amount that's over the par value is called additional paid-in capital. So you have an additional paid-in capital, which is the amount in excess of the par value, and that's $240,000. On the 7th of January, remember we talked about issuing an additional 500 shares of common stock to William in exchange for his service, and we said that the stock was worth, or the service was worth, $7,000 in that case. So his service, we're going to call it organizational cost expense, the $7,000. We gave him the stock, but of course, again, it's recorded at par, the common stock. Any amount over the par value is, once again, additional paid-in capital. So you got $1,000 for par value of the stock and $6,000 for additional paid-in capital of common. On the 12th, we issued 2,500 shares of preferred stock for $120, which is the market price. Of course, the par value of the preferred stock, when we read at the beginning, the par value was $100. So we record the preferred at par here, preferred stock at par. The excess goes in additional paid-in capital, of course, preferred stock. And of course, we record a debit to the cash for the total of $300,000. Let's go to the next one here. On the 14th here, which is January the 14th, we acquired land. Remember, we went back and we acquired a building site, and we gave 15,000 in common shares for that, and we said that those shares was worth about $15 per share. Of course, we record the whole value here on the land for $225,000, and the 15,000 shares we will show here at par. Any excess above the par, of course, will become, again, additional paid-in capital, and that's issuing the 15,000 shares of common stock for the land. On the 15th of November, remember, we decided we were going to pay dividends on common, which was 50 cents per share, and of course preferred was going to get dividends. We calculated the dividends on that. I'm going to show you how to calculate that. Let me put something here to show you that calculation on those dividends. You had common stock outstanding, and this is the outstanding amount here of 35,500. You multiply that times 0.25, was 25 cents, and that shows that you owe dividends to common for $8,875. Of course, this calculation here, the 20,515. These are all the shares that you issued, and that totaled up to the total number of issuing shares. Preferred dividends are always calculated like this. You had 2,500 shares outstanding. 10%. Remember, I told you we was going to come back and talk to you about the 10%. That's where the 10% come in at in the problem there, times the $100 par. That gives you dividends of $25,000 for preferred. Of course, if we didn't have enough money to pay preferred would be the only one that would be getting dividends. But in this case, we can pay common and preferred. So the total dividends came up to $33,875. I'm bringing the journal entry back in, and that's where we record the dividends, $33,875, and of course dividends payable at $33,875. Then on the 20th of December we paid out the dividends, so you have to debit dividends payable and of course credit cash to pay the dividends. We have one more here. Here it is. Have some more journal entries here. Remember, on December 31st, the corporation decided to repurchase some shares that was outstanding. In this case, they repurchased 100 shares, and of course for $17. And that's our cost at this point. Once we repurchase the shares, it becomes treasury stock. So you have to debit treasury stock for $1,700, and of course credit cash for the repurchase. Then on the 29th of December, we decided that we were going to sell some of the treasury stock that we purchased on December 21st. In that case, we sold them for $20 per share, and it cost us $17 per share. So we record the cash, $1,000 that we were going to receive. Of course, we credit the treasury stock for the cost, which is the $17 per share, and any excess, because we sold them for $20 a share, goes into additional paid in capital treasury stock. Additional paid in capital treasury stock. And of course, on December 31st, we closed out the net income. This is the net income that we had. That was in the income summary. And we put that over into the retained earnings, and then we closed out the dividend account. Close the dividend account by debiting the retained earnings for the total amount of the dividends, $33,875, and crediting dividends to close it out at $33,875. Now, what that does is it sets us up to prepare the stockholders equity section. And in order to prepare the stockholders equity section, we must compute the earnings, the retained earnings, to go into that section. And here is the retained earnings statement. We started out with 0 retained earnings in this particular transaction. Remember, we had the net income here of $147,200, and we must minus out, there's our dividends of $33,875, brings us to a ending balance in the retained earnings account of $181,075. Once we have that, now we can begin to prepare the stockholders equity section. And this is what it looks like. Your stockholders equity section, it looks similar to this is it. However, this can be changed around a little bit. But in this case, you have 10% accumulated preferred stock here with a value of $250,000, which is the number of shares issued times the par value, brings it up to the 250,000. Then outstanding on the common stock, we had 35,450 shares that's outstanding at $2 par, brings us to $70,900. And of course, we must go back and add up all the additional paid in capital that we recorded, and we had 50,000 in additional for preferred, 391,000 for common. Of course, then the treasury stock had a $150 additional paid in capital, bringing the total paid in capital to $762,050. Now, to complete the equity section, we bring in the retained earnings, which we calculated that from the retained earnings statement, which is 181.75, and we must subtract out the treasury stock that's left, because remember we resold 50 shares and we have 50 remaining in there. And this treasury stock is a contra equity account. So you must subtract out the shares that you're holding to bring the total equity down to 942,275. I know that was a pretty lengthy example, but you can download this example and kind of print it out and take a look at it. But that covers a basic stock transactions, which includes capital stock, that's common stock, preferred stock, and we did some treasury stock transactions.